Okay, that's Rajan of the PMEAC speaking about the projections for the year, 5.3%. Some people would probably put it a tad bit optimistic, but let's get in our experts to speak about this. A battery of guests with us. Let me start off with Maithili Busnurmat. I don't know if she can hear me, but Maithili, if you can hear me, yes, I can see that you can hear me. She's, of course, the consultant at PMEAC, and she joins us right now. Maithili, good having you. Thanks for joining in. 5.3%. If you assume that the second quarter is a bit of a washout as well, that would mean that the economy needs to grow at over 6% in the remaining 2 quarters or the second half. Is this an optimistic painting, or do you think this could well be achieved?
Well, it would seem optimistic as compared to the other projections that we've been seeing around, but given the fact that the PMEAC had estimated 6.4% in its April outlook, this is a huge reduction of 1.1 percentage point. So I think they have been fairly conservative, and if you look at the IIP numbers, maybe there are hopes that the economy might revive. And you must remember, this is a projection from the PMEAC, so it cannot really differ very widely from what the PM himself has stated in Parliament and expressed earlier also, that he does hope to see growth at 5.5% this year. But let me remind you, this is the first time, in fact, I think that the PMEAC number is less than the RBI number. The RBI projection that we have as of now is 5.5%, and the PMEAC is saying 5.3%. So let's see whether the RBI will further lower its GDP estimate in the forthcoming monetary policy on the 20th.
Okay, let's also introduce our other guests. We had with us Dr. Soumya Kanti Ghosh, Chief Economic Advisor of the Research Department of the State Bank of India. Also Samiran Chakrabarti, who is with us, and Nischal Maheshwari. Samiran, would like to bring it to you with respect to this projection of 5.3%. As Maithili mentioned, it is largely in tandem with what the Prime Minister also earlier spoke of 5.5%. But do you think that this is a realistic projection?
Well, it's much higher than what our number is, where we are at 4.7%. Our sense is that the reduction that has been done in the forecast is pretty substantial. So in that sense, there is an acknowledgement that the slowdown has been much higher than what was anticipated before. And there have been some quite difficult developments over the last few months, particularly on the exchange rate and the interest rate front. And it's quite likely that that will have its toll on the growth numbers. I completely agree with the report that the agriculture sector would provide some kind of a fillip, and even exports can provide some support. But other than that, it looks to be a difficult number to achieve.
Nischal, would you concur with that? Because you did have Dr. Rangarajan acknowledging the fact that we did have supply bottlenecks. There were some price shocks that did come about. Do you think that perhaps agricultural growth on account of the good monsoon is the only redeeming factor for achieving this kind of a number?
Yes, and I think the winter crop also is going to be good. So I think there would be a surprise as far as agriculture is concerned in the current year. But I think the numbers on the industry side are a bit optimistic, and though we have seen a good number coming in, but this is a sort of a one-off number basically if you do a deep dive here. So we have around 4.8% is the GDP number for us. So given that we are not looking at any easing cycle happening in the second half also, I do not think that a 5.5 kind of a number is achievable in the current year.
Maithili, I was just reading the document which has been uploaded as well. The agricultural growth projection is at 4.8%. Now, this is in stark contrast to what happened last year, more so at 2.7% for Q1. So there seems to be a lot of hope being pinned on the good monsoon and the achievable growth target. Just isolating agri at 4.8%, realistic you think, or even this is optimistic?
Well, I think it is a little optimistic, because though agriculture is supposed to be a good year this year, 2013-14 is supposed to be a good year because we've had good monsoons and the spatial distribution has also been fairly satisfactory. I think 4.8 is a little optimistic, but if you want to finally get to that 5.3%, the only way you can do it is really to pitch it in agriculture, because you're not going to get it in industry. You've already seen that, and even though the PMEAC estimate of 2.87% is fairly high, given what we've seen happening in industry last year, and also the fact fact that services sector has been slowing down, then where else can you get the growth which you want to achieve, that final figure of 5.3%? So I think it is a little optimistic. So let's wait and see. There is the base effect advantage of last year having been fairly low, but at the end of the day, it is certainly an optimistic estimate. But as I said, it comes from the PMEAC, so necessarily it will have to be at the upper end of the range of estimates that we've been seeing floating around. But one more thing that I'd like to point out is that inflation, in fact, they're estimating at 5.5%, as against the RBI's own estimate of 5% for March 2014. So while the GDP growth number is lower, the inflation estimate is higher. So clearly the PMEAC is not as optimistic as it seems overall.
You know, you preempted a couple of things, Maithili. One is that you spoke about industry, and they have stated that the industrial growth expectation is at 2.7% versus 2.1%. Again, seems optimistic. But you know, the other point, before we go on to Soumya Kanti Ghosh as well, Maithili, just coming back to you, you spoke about the inflation, and there is a comment that the PMEAC has made. I don't know if people are reading whether on that and preempting what the RBI could do. They have said that the current stance of the monetary policy has to continue until stability in the rupee is achieved and after the current trend in the moderation of WPI continues. You think the market may just put two and two together and think that if the PMEAC is also saying that, hey, things haven't stabilized too much, then maybe all that clamor for a rate cut might not actually come about, even though it's RGR's first policy?
Well, I think they've always said that the RBI takes an independent stance as far as monetary policy is concerned. But certainly when it comes from the PMEAC and the chairman is a former RBI governor, it will carry a fair amount of weight. But what the PMEAC report also says that once stability is restored, there will be some cushion, there will be some space for RBI to ease its monetary policy. So it's not as if they've ruled it out completely, but they've just said that as long as there's no stability as far as the rupee is concerned, the RBI will perhaps logically should continue, or however you want to read it, whether it's a direct, it can't be a direction, it's certainly advice. So there is that, but as far as industry is concerned, there is a hope that it says that once stability is restored, of course it does not quite spell out what exactly stability means, but it says that once stability is restored, then there will be space for monetary policy perhaps to ease its stance.
Dr. Ghosh, looking at the report, it was also mentioned that the better trade data will help in boosting the economic growth. Now, no doubt the trade deficit number did come in fairly positive and did manage to shrink. But do you think that was solely a reflection of the decline that we saw in the gold imports and therefore not sustainable every quarter?
See, there are two things over here. If you look at the gold imports in August, I think a little bit of has been postponed. So you can see a little bit of increase in the gold imports in the subsequent months. But having said that, the trade deficit, cumulative trade deficit for the first 5 months had come at around 73.4 billion. So at the same run rate, we also estimated the trade deficit should be around 180 billion. Now the PMEAC is actually estimating it at 185 billion. That's a 10 or 11 billion reduction from last year. And if you have gone through the report, another interesting observation is that it is also assuming that the invisible flows will increase from 107.8 billion to around 115 billion. So that actually explains the reduction in the current account deficit from 88 to 70 billion. So that is explains around 18 billion. I would like to also make a point over here is that if you also go through the reports and the projections of the portfolio capital inflows at 2.7 billion, the FDI inflows, I think the PMEAC is heavily banking on an inflow of the banking capital or the out of surge in the NRI deposits. So I think this is some of the, so that is, and also the increase in the remittances. So obviously what the report is suggesting is that the benefits of a rupee depreciation may kick in higher amount of remittances and the NRI deposits. And the other thing which you said in the course of the speech, Dr. Rangarajan, is that the investment number in the current year could be around 34.7%. So that means that the PMEAC sees some amount of revival in the investor sentiment, and that is clearly built into the manufacturing sector number, which is at 2.7%. I think the manufacturing number is a little bit on the upside. The agricultural sector growth rate 4.8%, even if you assume you are able to achieve that, but 2.7% manufacturing sector with a decline of 0.2% in the first 4 months will be difficult to achieve, and in my sense 5.3% is a little bit on the upside.
Okay, that's the consensus view. Samiran, the other bit would be on the CAD, wherein much to the surprise of a few people maybe, or maybe not so, but I wanted your views. He said that CAD could well be contained and could well dip sub that $70 billion mark as well. Now, this is not something that a few people anticipated, because most people believe that it will overshoot that number. What's your sense?
I think 70 billion is not a very unrealistic number to target. Our own sense is that the first quarter current account deficit, which would probably be in the range of $27-28 billion, this could be almost half to about $15 billion quarterly run rate for the next 3 quarters. So that would roughly give you a number of about 70. It is doable because a large part of the gold imports have got concentrated in the first quarter itself. So the next 3 quarters will have much lower number on gold imports. There is some moderation in capital goods imports as well. And if the domestic fuel prices are raised, and that also has put some kind of a clamp on oil imports, then overall you should start seeing some reduction in total imports. And export numbers have been good in the last 2 months. Overall, I would not be surprised to see a number in the range of 70 billion on the current account deficit front.
Nischal, do you think we're, forgetting the fact that on account of the rupee depreciation as well as the high interest rate scenario, there is also the possibility of a stagflationary scenario which would also dampen growth going forward?
I don't see a fear of stagflation, because we are still growing at around the worst numbers which I've seen on the street actually is around 4%. So, and inflation is sort of contained. Yes, there is a fear of inflation going up if rupee remains to be at around 70. There is a definite pressure out there, but stagflation coming in is basically, I think, a stretched view. But definitely, I think there is pressure as far as growth is concerned. That is what I really worry about. I think inflation is sort of contained. We have got a bountiful agricultural output, and I think that will put further pressure on the prices of the food products, which has been actually been the major drivers for the inflation side. So if that eases out, I see inflation coming off, and I would be bothered more about growth than inflation at the moment.
Fair enough. Samiran, with respect to that 5.5% number by March end for the inflation figure, on account of the supply bottlenecks that we've seen so far, as well as the way the currency has moved, how realistic do you think this target is?
So I think the implicit paths that they're looking at is that in the near term, inflation might remain elevated, might even go up because of the lagged effect of the exchange rate depreciation. But once the monsoon effect comes in on food prices, that should bring overall inflation down. I do not have too much disagreement with that number. I think it's a number possible to arrive at, provided there are no geopolitical shocks leading to higher commodity prices, which are beyond our control. Let's not forget that the challenge is not on WPI, the challenge is on CPI, where the number seems to be much more sticky and much more elevated.
Fair point. Okay, just a bit on the markets really before we go to our guests. I think we've bounced back into the green and led by the Bank Nifty. So the Bank Nifty took a toll on the markets and a bit of a dip, and now we are in the green by a comfortable margin, 11 points, and the Bank Nifty is leading the charge upwards. So that's really what's happening on the index front and how the market is reading what the PMEAC had to say. Metli, the report also says that containing the fisc at 4.85% of the GDP would be a challenge. Now, for the PMEAC to come out and admit this would lead a lot of people to believe that, one, it may not happen. If indeed that is going to be the case, could India face a risk of a sovereign downgrade as well?
Well, the finance minister is already on record that he will definitely, he calls it a red line, so he will definitely achieve the 4.8% is what he has really pledged. So I think even though the PMEAC has also warned that in the first 4 months we already touched more than 60% of the target for the year, I think given the fact that one will have to accept that the finance minister really means what he says, I think he will somehow manage, whether through expenditure compression or whatever, because the PMEAC has suggested compression of subsidies. Now that's going to be very difficult in an election year. But I think let's see, kind of go with the FM at the moment and see that he will achieve that fiscal deficit target. And I think if he does that, and if rating agencies are confident that he will, I think the risk of a sovereign downgrade is not so much, because somehow rating agencies put a great deal of weight on the fiscal deficit, though actually the current account deficit is equally significant, but they attach much greater importance somehow to the fiscal deficit. So if we achieve that and show intention as the year, months go by, I think one doesn't need to worry very much on that score.
Dr. Ghosh, just coming back to the point that you were making, and you sounded a bit skeptical about this growth target 1, yes. A lot of people are referring to the IIP numbers that came out, but the capital good number which comes out seems to be an aberration as well. What's your sense? I mean, are you convinced with the 2.6% IIP growth that we've seen in July, or that number plus the cap goods performance might be a bit of a flash in the pan?
See, there is 2 points over here. The first thing is that if you look at the numbers very carefully, I think there has been some outliers in the number this year, as has been the case earlier. One of them is the insulated rubber cable, which has grown at a rate of 336% in the month of July. If we strip out the rubber insulated cables, the IIP growth actually declines by minus 0.8%. And furthermore, there is another item, electrical machinery, which has grown by 83%. So if you also strip out that, the IIP growth actually declines by minus 1.7%. So I am not so much convinced about the sustainability of this number, because capital goods has been volatile. Having said that, there are two positive things over here, which if you note into the IIP data, that may look encouraging if the trend is sustained going forward. One of them is the trend in the leather, and the other is the apparel exports. Both of them has grown at a fairly stable rate and having a weightage of around 3.5% in the IIP. And given that these sectors are export oriented, I am not sure how the benefits of rupee depreciation may help them, but if it helps, that will be good for the export story, because garments and leather are two sectors which could contribute to the export upside. But here also, the trend, if you look into the trend, the benefits of the rupee depreciation, assuming that they have benefited these two sectors, it is not having an uniform impact. For example, some of the sectors like the electrical or the transport equipment have actually declined. So let's hope that this trend is sustained for the coming 1 or 2 months, because if you look at the US import data also of the apparel imports from India, China, Bangladesh, Sri Lanka, you will see that India has actually gained a little bit of market share in the current fiscal year in terms of the apparel exports.
Let's also pull up the currency and see where that's headed right now, because you did have it snap that 5-day winning streak. Yes, we did see some appreciation come about, but as we speak, currently at 63.80. Now, Maithili, you had Dr. Rangarajan clearly maintaining that the monetary policy stance needs to persist until and unless we see some stability returning to the currency. So what steps would you like to see on that front?
Well, a lot depends. I think at the moment it will be very dangerous to stick one's neck out and say anything, because we have to wait until the FOMC rate statement comes out. So if they announce something on tapering, the pace of the tapering, a lot will depend on that. So at the moment, there's very little one can really say about the rupee, because one really doesn't know. If the FOMC tapering is deferred, then we could perhaps see the rupee strengthening. But if the FOMC says, well, we're going in for tapering and we're going to do it fast, things could be very dramatically different. So at the moment, I think it will be very difficult to say when stability will return to the rupee. But there's one more point in the report which I think perhaps will gladden the hearts of all our viewers, and that is that the PMEAC has said that the income tax exemption that is given for investment in long-term instruments, which is currently only 1 lakh, could perhaps be raised to 5 lakhs for investments over 5 years, and that I think would be something that all taxpayers would certainly look forward to. And this has been suggested as a means of improving the investment levels in the country.
And Dr. Rangarajan also mentioning that the rupee can only stabilize if the FI flows continue. So, Nischal, what kind of an impact do you see the currency taking on the FOMC meet outcome?
I agree with Maithili. Actually, I think everybody is awaiting with a bated breath. And if it is going to be a tapering light, actually, I think you may see rupee stabilizing around here. But if it is going to be a higher weightage, basically where they are looking at withdrawing at a much faster clip, then you are going to see pressure coming on the rupee. I think FIs are also waiting for that to see how the rupee stabilizes. Second thing is, which I have highlighted earlier also, I think it is a question on the growth. So yes, rupee may stabilize out here and inflation may be low, but I think everybody now wants to see basically what kind of growth what we're talking about, how the investments are going to be coming back on the ground, what is going to drive that, and if the FM is going to hold on to its 4.8%, where the spending is going to come from. So those are all the questions basically FIs have in their mind, and I believe nobody is in a hurry to actually come back to the country.
Yeah, and Maithili, that's the point. I mean, we've seen the last 3 or 4 days some bits of inflows coming into the equity markets, but speaking to bond dealers and treasury experts, and they say that there is almost a complete absence from the foreign institution investors in the bond markets even now, though we've seen a trickle in the equity markets. How do you see that equation shaping up? One, the bond prices, the yields thereof, and two, the interest of the foreign holders in the debt markets.
Well, they're all very closely linked. I think the bond market and the exchange rate, both are very closely linked. And we'll also have to wait and see what Raghuram Rajan announces in his first review of the monetary policy for this year. Will he lower the GDP estimate? Will he announce something on the interest rates? Will he kind of roll back the whatever tightening measures the RBI has taken? So it's very difficult to say about bond yields also, because though at the moment we feel that the fiscal deficit target will be achieved, if there are any indications that the government may overshoot its borrowing, then again that will take a different, the RBI to take a different view altogether. So at the moment, I think it will be very difficult to say, as far as bond yields also is concerned, have we seen the end of whatever drama that we had in the past 2 months.
Yeah, speaking of those FI inflows, Nischal, they have been fairly persistent despite the volatility that we've seen in the equity markets. Do you think that now, with all of the focus on the FOMC meet, that we might see a slight tapering off? And how do you see the next few weeks or month rather panning out for the equity markets?
Yes, I think in the next few months, a lot depends upon how the QE actually works out. Because if there's going to be tapering light, then obviously we are going to see some strengthening on the rupee, and that would definitely bring back some amount of interest on from the FIs. But I think on a larger level, come at around 6,000, 6,100 of Nifty. There is going to be question marks against that, what kind of growth what we are pursuing, because at 6,100 Nifty you are going to have an earnings issue and the valuation, because at 6,100 you are at a long-term average of around 10 years at more than that actually, so more than 15 times FY14 earnings. So I think in the short term the question will come back to growth. What kind of growth we are expecting in 14 and what is going to happen in FY15, both in terms of the GDP as well as earnings. So that is what is going to actually drive the markets beyond a point.
Okay, just before I come to Dr. Ghosh, Maithili, I just want to come back to you about a point that you mentioned, and I was trying to find it out as well. Did you mention that there has been a change in the investment instrument limits from the current 1 lakh per year to a higher amount? Is that something that you highlighted?
Yeah, this is just a suggestion by way of, when the report talks about how does one increase savings and investment, one of the measures it is suggested that perhaps the government could consider is if you raise the income tax level limit from currently 1 lakh for investment in long-term instruments, it could perhaps be raised to 5 lakhs for any investments of over 5 years. So this is just a suggestion. It's from the PMEAC, where the government will act upon it, and if so, when remains to be seen. But even the hope that it might be raised, because remember, this 1 lakh limit has been there for many, many years, and there have been lots of demands from taxpayers that this needs to be increased. So if the PMAC gives that kind of a suggestion, maybe the government will look at it more seriously than if it comes from ordinary citizens like you and I.
Wow, 5 lakhs. If it gets taken up to 2.5, Maithili, I'm sure a lot of people would be very happy. Dr. Ghosh, the other bit, aside of course, the talks that we had about the GDP, just one word from you on the CAD as well. Do you believe that the 70 billion mark is achievable? Because a few people have been rather skeptical about that too.
No, I believe that the CAD number 70 billion is eminently achievable, because I mean the estimates, the way they have been built, and if you look at the export trend and also the import trend, and most importantly if we talk about the gold imports, I believe there will be a tapering of gold imports, although there could be some minor amount of upside in the festive season. But if we can contain the gold imports to around 40 to 45 billion, I think 40 billion was what we had in FY11, and then it went up significantly to 56 billion in the last 2 years. So if we are able to cut down on the gold imports by around 15 billion, 10 to 15 billion, I believe that we could hit a CAD target of 70 billion, or there is every possibility that we can also go a little lower from the 71. So I am not so much concerned about the current account deficit, but the fiscal deficit target will be a challenging, and I hope that that will be met the same way it was met last year.
All right, Dr. Ghosh, Nischal Maheshwari, and of course Maithili Bushnurmat, it's been a pleasure having you joining in on the show and giving us your robust insights and opinion on the economic growth forecast that has been set by the Prime Minister's Economic Advisory Council. We'll take a quick break and be back with Market Sense on the other side.